Thank you very much for your kind words, Nicola. Now, for some reason, they decided to put this is the old me, and then there's the new me, and somehow I seem to, of all the people Nicola was talking about his tie, I have no tie in that picture. That's usually a good thing if you're able to not wear a tie. Last year, I also said, avoid expert advice. And again, when we talk about the media, we're bombarded with information from experts. And when we get up here to speak to you, we're trying to help you fundamentally with your investment decision making. Last year, I spent a good chunk of my presentation on the difficulties that we have mastering, and Ian talked about it, our emotions when we make our investment decisions. I actually had the privilege about, I think it was 10 years ago, hearing Daniel Kahneman speak at a seminar before he'd won the Nobel Prize. And he won the Nobel Prize in partnership with, he won it alone, but his partner in crime actually died before he had a chance to receive it. But basically they went through on a clinical basis and in the lab, and they showed that we really aren't very good at making decisions and that our emotions do master us. So in the essence of continuing the process of trying to help you, and I like to call it today because we're all here together, it's like group therapy if you want to call it that, I want to explain how the media distorts our ability to sift through what's relevant and what's not. I think it was Peter talked about the drumbeat. Drumbeat was a word that Peter Lynch used in his book. And basically what happens is when there's huge amounts of information, the same information that we're bombarded with, it creates this concept of availability where we actually end up not giving enough importance to other information that might be actually equally important. And I can give you an example in terms of our own personal experience. We travel extensively. We visited, I think from March of 2011 till the end of the year, we visited 18 cities. And what was really interesting in our interviews with our CEOs is we got the feeling from them that business conditions were actually improving. The underlying economy was improving. But it really got no sort of coverage in the media, even though there were little sort of, back to the green shoots of 2008. And in our interactions with our clients, really all the clients wanted to talk about was Europe and how that would affect the portfolios. And yes, there are real effects in terms of what's going on, the interlinking of the financial system. But what was missed was really good underlying performance in our companies. And it wasn't top of mind because it wasn't reported. We feel that there's no doubt that what you're facing as clients is there's really a crisis of confidence happening worldwide. Our governments haven't served us that well, and then that has filtered back into how people feel about investing. The lack of positive returns that Ian spoke to, even though there are pockets of satisfaction with U.S. investments in particular, it's led to a fatigue with equity investing and sometimes even almost a loss of belief in whether the process really works. Jeff was talking about having to buy the fundamentals and then expecting or hoping that over time those fundamentals will get recognized. Well, we're in a period now where our clients, where there's really an underinvestment that's happened in stocks, and particularly I'll get to it later in U.S. stocks. But when I get to the part of my presentation that talks about the power of the entrepreneur and Nicola's comments on what was said in 1992, I was doing a little calculation. When the first cell phone licenses were applied for in the 70s and early 80s, the original estimates, I remember the founder of Bell Mobility, they told Communications Canada they thought there might be 100,000 cell phones. And a bit like other new products, people said, what do you really need those for? Well, if you take, I think it's 75% penetration in the United States now, that 8 million has grown to 250 million wireless devices. So it's really quite an amazing thing. The other thing that we get is there has been disillusionment with managed products. Hedge funds, which are high fee funds in many respects, did not hedge for investors. And so the questions have come up over the last 4 or 5 years. There was a famous book written, Where Are the Customers' Yachts? And it's definitely been a tough time for our investors. And I don't think that the industry has done itself any favors. So now what we've faced in the last couple of years is low returns, you've had low interest rates, you've had dissatisfaction with stocks, and so our investors are struggling with trying to understand where to put their money. What we told you last year is to take the emotion out of it, to debias yourselves. It's the importance of having a plan. And so working with Peter, working with Mark, it's really important to have a plan and stick to the plan. And then what that does is it gives you the strength to ride through the cycles. Looking back on 2011, Canada was obviously a more difficult stock market. Over the years, the Canadian stock market has become quite a bit narrower there's been takeovers, natural attrition. The early 2000 market was very hard in the Canadian tech and telecom sector. And then what we saw in 2011, and again, this is a message about Canada, the leverage to global growth, it actually cuts both ways. And so as fears emerged in 2011 that demand for the rocks and trees of Canada weren't going to be quite as robust. Of course, that stock sector struggled, and the more speculative companies, companies that also may have had questions about access to finance, they struggled even more. I'm happy to tell you in our portfolio, we had many of our resource companies well-financed, showing production growth with low-cost structures that performed quite well, but it was still a difficult environment for that. And I think what it really also highlights is the importance in Canadian fund management and you as investors of remaining diversified. Some of the best performing stocks in Canada last year were non-resource companies in the tech service areas. And there is a bit of a tendency among Canadian investors to get caught up in the resource theme. The other theme that worked very well in 2011 in Canada was the whole dividend theme. And Bell, being the bellwether of that, raised its dividend a couple of times in the last couple of years. And as Nicola said, our portfolio of dividend-paying stocks did very well. Moving on to the U.S., clearly the markets confounded the negative sentiments. And again, back to sort of a behavioral analysis, it really is another example of how markets will confound investors. And what we can report to you is that the last 2009 was a recovery year. It was an emotional year as valuations came back up. But 2010 and 2011 in the Pembroke managed U.S. portfolios, they were really fundamentally driven years. The underlying companies did great. And really, when you look at the U.S., and we've been investing there since the late 60s, it's really a testament to entrepreneurship, the flexibility of the system. Our companies go out and cut costs. They're able to do it much, much faster. The labor laws are different. And it's a market that, on a long-term basis, we still think is very dynamic. The other interesting development last year was the unloved blue chip stocks, which really it's almost 11 years of relatively no return. They actually outperformed small cap stocks last year, and investors looked to the dividends, good balance sheets. There was some exposure to international growth, and then the irony for you as investors is that America still looks interesting. Again, we travel extensively, and we think that over the last decade, Canadians have become underinvested in the U.S. Here's a chart on earnings. You can see the earnings are above prior peaks. Here are two slides on valuation. Canadian valuation's interesting, a little higher than the U.S. The U.S. valuations, and these are the larger cap stocks. Even David Rosenberg, a super bear, he wrote a column this week where he grudgingly admitted that U.S. stocks were cheap and might go up. And then I think Jeff hit it right. What happens is you reach a point where you have both valuation and growth working for you. And the time to invest is not when it's all signals go, everyone's excited, people pouring money into things. The time to invest is when there's uncertainty and when people are afraid. And I think what we try to tell you is what's important is to structure your portfolio to suit you and then have the dosages of things right, and then that will allow you to sleep better. And this is another anomaly that's emerged and again is driving the dividend growth theme. You have companies with growing dividends and growing companies, but the relationship to bond yields has dramatically changed. And again, this is a reflection of the flight to quality, to people's view of certainty, and they would rather have a 2.5% 30-year bond rate than a 4% dividend in a quality growth company. So within the portfolio, there are, for you to understand, there are powerful themes driving our investment approach. That while we build our portfolios on a stock-by-stock basis, that there are, even though it may be a subdued growth environment, that there's many themes. You see the cost containment theme, outsourcing continues to be profound, technology is a productivity tool. It's basically where companies are investing, driving down their costs or driving their access to customers. And then we are, in Canada, it's unavoidably exposed to the energy and resource industry, and those address the themes of in the oil industry where technology is being used to enhance recovery. And then obviously, if Jeff's thesis of China and the other developing markets plays out, Canada's in a wonderful position in terms of selling our assets into those markets. Over the years, people ask us what gets us out of bed in the morning, and I would say what I call the power of the entrepreneur. Ian put a slide up about Steve Jobs. Think of what he did in a very short space of time. He reinvented multiple industries. And what we like to say to you is, in super uncertain environments, even it could be in recessionary times, there's some brilliant younger person, some executive toiling away, defining the next Apple, and that's really what excites us. And over many years, many of the companies that you think of today as blue chip stocks, they were birthed in uncertain times. As Nicola said, in 1992 we were coming out of a recession, and the reason that actually the Gazette asked Ian Suter and me to write that article was because there was a loss of faith in stocks at the time. So what happens is these things are cyclical, they repeat themselves. Some of our best investments in the last year, their opportunities came out of the crisis. One example is a Toronto-based company, First Service, that has a division called Field Asset Services. What they're doing is they're helping the banks deal with foreclosed properties. When they bought that division in 2007, it was doing $60 million of revenue and $8 million of cash flow. In 2010, it did $360 million in revenue and $60 million of cash flow. So that was basically a flexible entrepreneur profiting from other people's difficulties. Continuing on the theme of aligned interests and the power of the entrepreneur, this is a locally based company, again, trying to give you a flavor of the portfolio. What we really want to show you here, the blue line is the cash flow that the company, Paladin Labs, has generated over the last 6 or 7 years. The blue, bar charts. And then the blue line is the share price. And again, back to what Jeff said, is over time the share prices will follow fundamentals. Paladin has a family that controls it, owns 35%, manage themselves very responsibly through the crisis, and then has a great chance to take the excellent Canadian model they've created globally. Liquidity Services is a newer investment in our portfolio, and again, just to give you an illustration of what they do, and again, think of how this plays to an environment where retailers might be struggling. They take overstock and liquidation goods, and they put the seller, who has a need to manage his inventory and generate cash, and they put them in touch with motivated buyers. The magic, again, is not finding the sellers, because there's lots of sellers. It's finding the buyers. And again, this is a stock that Nicola and Matt discovered a couple of years ago. Nicola had actually seen them present, but had felt the valuation was high. But then what happened is the stock market created an opportunity for him to screw up his courage and buy it. And again, when I look at, people say recession, and I say, what recession? In 2010, the revenue grew 21%, 2011, 30, 2012, 32. So what you can see, again, the share price follows the fundamentals. On the theme of dividends, this chart's a little bit different, and again, it's just an illustration to you of why we're excited about the Canadian dividend-paying stocks. This is a small to medium-sized Canadian company in wireless retailing. Again, has a family that controls it, motivated to maximize return on capital, grow the earnings and dividends. They've been raising the dividend over the last 3 years, and this has been a very interesting holding, and it's got a multi-year opportunity in the U.S. with Verizon. And again, as you can see, the share price has tracked the increase in dividends very nicely. We have told you over the years, and this is just to reemphasize, we run diversified portfolios, multiple industry exposure, Canada and the U.S. And We think that's important because oftentimes you can get caught up, again, back to the behavioral aspects. We can get caught up in the moment, and you might have had too much resource last year, or it would have been easy, and we certainly did experience that in 1999, 2000, having too much tech. So the diversification is important. What we're telling the clients about Canada is recognize that Canada is a cyclical stock market. And as virtuous as the press will say we are in terms of Canada's balance sheet being better and the deficits being better, when you do a look through and see the condition the provinces are in, et cetera, pension liabilities, we're good, but we're not as great as people think. And actually, as you saw from the slide on Canadian equities, the Canadian market's actually a little more expensive than the US market. We encourage people to look at the non-resource names. While there's great leverage in the resource sector, the Canadian technology sector remains undervalued. There was another takeover today in the market. I think M&A will continue as a theme in Canada. That's, I think, the third this year. And the resource focus that we have and that you should think of is resource companies that are self-financed or that can finance themselves, earn a good return on capital, or low-cost operator, so that they're not as exposed to the fluctuations in commodity price. Because what can happen is if the commodity price is a part of the thesis, if it's a tougher time like last year, you see the negative leverage in the stock price. And then we think that the dividend theme will continue to resonate in Canada. As far as the US goes, we'll re-emphasize it. I think this is the third year, maybe. The world is underinvested in the US. And yet, when we travel, we see the U.S. as a hotbed of entrepreneurship and then intellectual property. I was reading a newsletter last night or a couple of days ago preparing for the speech, and it basically said, in a way, it undercounts what's happening in the U.S. because of the power of the patents and the intellectual property. Absent a huge external shock, which, again, Jeff said, you can't forecast these things, very hard to do. The news flow should be incrementally better. There is a low-key recovery unfolding in the U.S., and that we think that our world of smaller companies, while they performed very well in the last 3 years, and so it's hard, to hope for a four-peat after a three-peat, but we think that smaller companies will continue to do well because they're growing and because of innovation.